As you know, the weekly data are always confounded a little bit by redemptions and the week-to-week special factors, but it does reflect our commitment to have a substantial increase in the pace of purchasing. I wouldn't take any one week in isolation, but of course, if you average over several weeks, you will see this substantial increase in a consistent way.
If you look at the situation on the bond markets, why are you so concerned? Because if you deduct inflation from the nominal rates, then I guess real rates are more or less not such a problem, right?
Well, we have an inflation forecast which remains quite low. So even in 2023, inflation's only at 1.4 in our forecast. And in that context, essentially, we would like to see fairly low rates remaining. And in fact, if we do see expected inflation pick up, and let me emphasize, what really matters with expected inflation is economy-wide, not just the viewpoint of financial traders, but we would need to see it in firms and households as well. But ideally, any inflation, any pickup in expected inflation, if it adds to inflation momentum, we welcome it. And I think you have to compare the nominal yields we see against the inflation forecast we have, which remains pretty low at 1.4 at 2 years ago, 2 years ahead.
Yeah. When we talk about inflation, the Fed clearly has opted for allowing overshooting. What would be your stance? Would you follow the Fed in that respect?
Well, I think that's an interesting debate, and as you know, we have a strategy review, and we're still in the middle of that. But behind, what is the deeper point here? The deeper point is in a world where essentially lots of central banks have a situation right now that inflation is too low compared to the target. I think the universal emphasis and our emphasis has to be to make sure that monetary policy support remains in place until inflation is robustly where we want it to be. We've already given that forward guidance since September 19. We want inflation to robustly converge to our target. And if you like, that should provide enough guidance that monetary policy support will be in place until we see that robust convergence.
Would you say the outlook for economic growth now and also inflation might actually deteriorate with what we are seeing when it comes to the spread of the coronavirus in Europe, especially also in the big countries like France and Germany, which went straight into lockdown again?
So it's important to emphasize when we made our recent forecast a couple of weeks ago, we did allow for some extension into the second quarter. So the fact now we're seeing decisions to have lockdown measures extended into April is maybe not too surprising. But I would share the concern. And again, it's not about the lockdown measures because those just reflect the underlying contest with the virus itself. So until the virus is more contained, until we have, I suppose, more progress in vaccinations, until it's clearer that these mutations are not going to have a very prolonged impact, it is clearly a risk factor. So this, as you now go into the second quarter, it's going to be a long quarter. We do have the news, the kind of concerning news about the fact that the virus, the case numbers are remaining high, in fact, are creeping up. On the other hand, we also think in quarter two, over these 3 months, April, May, and June, there will be a lot of vaccinations taking place. So over the course of these 3 months, it's a contest between progress in vaccinations and other medical progress versus the near-term challenge of trying to get this virus under control.